A lot of investors like to turn to Warren Buffett as a North Star, a potential guide for finding value. And folks like to look at their Berkshire Hathaway's quarterly holdings updates. And you can see the latest just came out this past week on what Berkshire Hathaway owned as of December 31st, 2022. So there's a little bit of a lag, but this is a really interesting data point to see, oh, okay, maybe he's finding value here, or is he selling a lot of things? What does that potentially tell you about the environment right now? And potentially, are there compelling bargains to be had? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. Let's dive right in to understand, well, what's Warren Buffett potentially thinking and where is he finding value? Well, one should understand as of the third quarter, Berkshire Hathaway held over $120 billion. So they are definitely in the hunt for attractive investment opportunities. They have a lot of cash to deploy. And at this point, they have, arguably, they're not finding a lot of stuff to do because their cash pile is building up. That was as of the third quarter. As of the fourth quarter, so this is based on their holdings, not a lot changed, folks. The only thing that, this is the top positions, by percentage of the portfolio. Apple is one of the largest positions of their, stock portfolio, around 40% of their stock portfolio. And, folks might say, oh, he made a small incremental, investment in Apple. That's actually not the case. Berkshire Hathaway acquired a company called Allegheny, and Allegheny owned a little bit of Apple. And so that just got added to their existing stake in Apple. They weren't really adding to Apple. And then you look across the board, it's really no change. He just had a couple of trims, a couple of sales. And that's actually another really interesting data point. Chevron's one of the top positions here. So this is arguably a bet on, oil prices staying flat or moving higher because Chevron trades at a relatively cheap valuation. Activision's a play on Microsoft, the deal going through at a much higher price. He's trimming that. So maybe, less certain that it'll close and that they'll successfully, achieve the price that Microsoft was willing to offer. I think it was $95 a share. And so looking at, what is he doing? What is he buying? Is there a potential source of opportunity? It seems like, and keep in mind, this is just U.S. holdings. You're not able to see the foreign holdings at this point. It really doesn't seem like they're finding much of a bargain at all, because really, you have Apple, which I already called out, really wasn't an additional purchase. There's Louisiana Pacific, which I believe is a home builder or home materials company, $400 million purchase. So this is one of his lieutenants. This doesn't get Buffett's interest. It's much smaller, much too small. He's interested in the $100 billion big game. And you have Paramount. That's a $1.6 billion investment, likely one of the lieutenants as well. I'm personally skeptical on this bet. I know a lot of folks are excited to see that they own 15% of the company, but the reality is it's not really that meaningful as a percentage of Berkshire's investment portfolio. 1.5 billion just really doesn't move the needle for them. And then when you partition it from buyers to what are they sellers of, they were clearly a net seller during the fourth quarter, trimming down a lot of different positions, trimming several of their banks, USB, BK. You can see they trimmed each of those positions, one by 90%, one by 60%. They also cut Taiwan Semiconductor by nearly 90%. This was previously one of their largest bets in the third quarter, to the tune of around $4 billion. So to see them cut it nearly 90% does make one wonder, is this because the business is so capital intensive and that there's not going to be a lot of free cash flow that can get returned to shareholders? And that's one of the concerns that I called out in my video on Taiwan Semiconductor. Or is it more about concerns about geopolitical risks and saying, hey, I just don't want to be part of that, or it's just too hard to sort of handicap the concerns of, Taiwan, China? How does that sort of play out over time, over a multi-year, potentially multi-decade perspective? And so looking at this is very clear to me, seeing that he trimmed the portfolio to the tune of several $billion, and he already held $120 billion in cash as of the third quarter. And he has a company, he has just cash flow. It's just raining cash for him at Berkshire Hathaway. He's probably, each year easily 20, 30 billion in free cash flow. Then you factor in what the portfolio is doing. So, going from 120 billion in cash to probably more now because of these sales. Now, it's unclear if anything else they were investing in, maybe, foreign stocks, but based on this data so far, it does look like he was actually reducing his risk. Okay, so there are some interesting data points here. What do I think Warren Buffett is thinking right now in terms of the investment horizon? What can this mean for you? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also launched 2 educational courses, one on financial statements and one on valuation analysis. Both were designed from the perspective of this is what I would have wanted to know when I first started working on Wall Street, just sort of based on my own experience. In full disclosure, this is not financial advice. So what do I think Warren Buffett is aware of? What do I think he's reflecting on? Because Warren Buffett and Charlie Munger, it's all about taking reality as it is and adapting to the reality that you see, not sort of living in your own head, sort of saying, okay, this is the environment. How am I going to be opportunistic about it in a way that makes sense and fits my, my rational approach? So let's see what I think he's reflecting on. What is sort of the data that he's looking at? Well, FactSet does a great job of describing, on a sort of broad level, what is going on with the S&P 500 across the 500 different companies. And so far during the fourth quarter of 2022, this is as of February 17th, 82% had reported their results. 68% were positive. 65% of the companies have reported a positive revenue surprise. So that automatically seems favorable. But this is the part where inflation starts eating you up, because the blended earnings for the S&P 500 was actually down about 5% for the fourth quarter. So you're starting to see a real rollover in the earnings for the S&P 500, at least based on the 80% plus companies that have reported. So positive revenue surprise makes sense in an inflationary environment, but also that earnings decline, your input costs are going higher. That's also a component that you're starting to see. And this is what's being reflected in the economic data, sort of summarized by FactSet. And they're talking about this is the first time the index has reported a year-over-year decline in earnings since the third quarter of 2020, which was around a 6% decline. And that was, immediately in response to the COVID lockdowns. Looking at guidance, so how do companies look at sort of the next quarter, year ahead? Most of these companies or a lot of the companies that have offered guidance, 65 of the S&P 500 companies, they're issuing negative EPS guidance. 20 have issued positive. So the vast majority of the companies that are issuing guidance are negative versus positive. So this does also reflect the outlook on the current environment. So this is a very important data point to consider when you're thinking about the price you want to pay. Things aren't looking particularly great. The costs are going higher, earnings going lower, and management saying, hey, we think things might be worse, or negative EPS guidance. That's an important data point. Why is this an important data point? Well, there's another aspect that investors, and particularly I think Warren Buffett's reflecting on, is that, look, as I already mentioned, he has $120 billion in cash. Previously, that was yielding close to zero. Now he's getting, with current interest rates where they are, between $4 and $5 billion a year in extra income from that. $4 to $5 billion. Think about how much that cash is coming in. That's wonderful for Berkshire. There's a lot of other, insurance companies that have not a lot. There's a handful, I should say, that have intelligently positioned themselves for this, a higher interest rate environment. One of my top investments is an insurance company that exactly is leveraging themselves off of higher interest rates. And I look at Warren Buffett and I'm thinking he's getting an extra $4 to $5 billion a year. He's probably saying to myself, you're going to have to give me something compelling in the stock market to make it worthwhile for me not to collect that $4 to $5 billion a year. Now, if you want to get, a 4% plus, return or yield currently on your cash, that's what Interactive is currently offering. There's a link below for Interactive. That's the brokerage that I personally use, Interactive. So once again, link below. And that's, very, very interesting. So we've already covered a few points Warren Buffett's thinking about. The first is that earnings are starting to roll over. So he's looking at weaker economic data. The second point is there's a real opportunity cost now. You can't just have your cash just build up and not get anything. You're sort of saying, hey, companies need to offer me something. And when you're offering Warren Buffett something, you either need to be offering tremendous growth and obvious growth, or you need to be offering a real free cash flow yield. So the company needs to be earning, sizable amounts of billions of dollars of cash, and it traded a reasonable enough valuation that Warren Buffett would say, this is worthwhile for me to exchange that $5 billion I'm getting each year for this company, because either the growth prospects or they're going to be returning that cash flow to him effectively via buybacks. So then you look at that dynamic and you see the prices have gone up. Since, the end of September 2022, S&P 500 up around 12% total return. So prices have gone up when he's looking at things that aren't he's not even really finding things that are compelling. And arguably, the environment has gotten worse for an investment standpoint, where he goes, well, you're really going to, the more Jerome Powell raises rates, the more you're going to have to make the stocks really compelling from a valuation or growth perspective. And by the way, you're looking at earnings rolling over. So I'm doubtful that you're going to be able to say high confidence that earnings are going to be tremendous over the next few years. I mean, that's ultimately one of the byproducts. As you raise interest rates, it does hit demand because people can't either afford it, credit card debt, or, different industries are impacted. And so you're starting to see that. And so it's an interesting dynamic. This is how I think Warren Buffett's reflecting on, is that you're going to need to compensate me. So let's actually look at an example of one of his previous transactions. So previously, he bought Burlington Northern. This is one of the largest rail systems in the U.S. And the announcement came in November 2009. So this is during the great financial crisis. And he's making a $34 billion bet on Burlington Northern, a huge bet on the company. Warren Buffett says, look, I love these all-in wagers on the economic future of the United States. I love these bets. And by the way, when he was doing this deal to acquire Burlington Northern, the stock had to fall enough for him to say, okay, the stock's now so cheap that I recognize that I'm going to have to pay a premium for this because I want to control it, that he's going to pay a 30% plus premium to acquire the business. So the stock has to be cheap enough to get him interested, to get him to say, hey, I'm willing to do the work to acquire it outright. Okay, so what did that mean for Burlington Northern? Well, Burlington at its peak, because in 2008, you actually saw peak earnings versus 2009, where you started seeing the recession, their earnings were rolling over. So at its peak earnings, it was around 16 times. That's ultimately the multiple that he was paying. And keep in mind, the market previously, because he's bidding 30% above where it's trading before, it was effectively trading at like 12 times peak earnings. Now, that shows you how Warren Buffett thinks about opportunity costs and the opportunities that he's looking for. Incredibly stable businesses. He would love to own the stock at low teens multiples, buying something in a mid-teens, maybe even close to 20 times earnings multiple. Think about that cash flow that's getting returned to you as a shareholder. If he gets control, mid-teens, if he's getting control, and you're getting that growth over time. And you can see how they delivered growth. I mean, you could see how they were growing their net income. They were growing their revenue. They were reducing their share count from 371 million to 344 million over, 3 years. They reduced it. They were buying back stock. They were paying dividends. Business was growing. They had pricing power. There's a lot to like here. And he's buying this business because there's recession concerns. And the stock got down to low teens and paid a premium to get to 16 times. So let's compare that to where we are today. Today, you see the S&P 500. The S&P earnings, as I've already called out, are starting to roll over. And so S&P is currently trading at around 20 times peak earnings. Is that really that compelling relative to arguably a better than average business, Burlington Northern, which he acquired, and subsequently it's done exceptionally well. You've got the pricing power, the volumes going up. So you look at that and you think Warren Buffett was focused on finding these things at mid-teens to low teens earnings multiples, lots of free cash flow and able to buy back stock compared to where we are with the market. And honestly, this makes me think it's still and increasingly a risk-off environment for a lot of investors that want to be very disciplined about what they buy. And I think that's what you're seeing with Warren Buffett sort of saying, hey, I'm just not seeing that compelling of a deal. If there was something that lined up with these parameters, let's say a great company at, a compelling multiple, I think he'd be willing to buy it. And I personally called out to my subscribers at Unrivaled Investing recently, effectively a financial toll booth trading at 14 times earnings. So like that, it's starting to line up. It gets me excited. It's still not crazy cheap like the 12 times example of Burlington Northern, but that was during the middle of a great financial crisis. So I think about these dynamics as I look at my own personal investment portfolio. Like, is this a compounder at a cheap multiple? So I look at Warren Buffett, how he's thinking about the market right now. I think he's looking at this, and very similar to a lot of investment videos that I've called out previously, I think this is an environment where you say, hey, I'm getting paid to wait. And so if I'm getting paid to wait with 4 to 5% 4% plus on cash, closer to 5% on like 1-year treasuries, why not just sit and wait for when I see things that are at really, really compelling multiples? And I find that great business trading at a very reasonable or cheap multiple, especially when you see the S&P 500 at 20 times, where Warren Buffett was willing to pay only 16 times for a great business. That would suggest significant downside potential for the S&P 500 if you were to have some sort of comparison and maybe, hey, this is what Warren Buffett was willing to pay for a great business. Is the S&P really that much better? Should it be trading at this 20-30% premium? So that's for investors to decide. That does reinforce my own personal bearish bias at this point. So we're saying, hey, I don't think the crazy opportunities are there right now. So I'm not, eager to go all in. And so it's another reinforcement of like, hey, there's a reason why Warren Buffett's building his cash pile. Maybe that's a data point for you as an investor as well. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.